Today we are going to discuss about the fourth chapter in financial management, cost of capital. Cost of capital. Today's learning objectives explain the general concept of opportunity cost of capital, distinguish between the project cost of capital and the firm's cost of capital, learn about the methods of calculating component cost of capital and weighted average cost of capital. Recognize the need for calculating cost of capital for divisions. Understand the methodology of determining the divisional beta and the divisional cost of capital. Finally, illustrate the cost of capital calculation for a real economy. Right. It's introduction. So you have already studied about what is opportunity cost of capital, what opportunity cost. I think it's the first time you are studying about cost of capital. First, we will look at on the project cost of capital. The project's cost of capital is the minimum required rate of return on funds committed to the project, which depends on the riskiness of its cash flows. So, for example, you are going to start a new investment project. Say you are going to buy a machine which produce certain items and you sell the items in the market and you will earn a sort of profit, right? Your investment is purchase the machine, purchase of the machine. To finance, to purchase that machine is an investment. We have taken a loan in a bank at 15% per annum, right? You have financed, you have invested in machine. That investment is taken from a bank loan. The bank loan, for the bank loan, you have to pay interest 15%, right? Interest is 15%. My question is, how much you are expect from that investment in that machine? What is the minimum return you are going to expect from that machine? What's the minimum rate? Rate of return is 20%, above 15% or below 15%. To that machine, right? To purchase that machine, you have taken loan from a bank. For that loan, you have to pay 15% interest, right? If you earn return on that investment by selling the items produced by that machine, you should earn at least 15%. If you earn return on that investment more than 15%, you will be end up with profit, positive NPV. If you earn return on investment, as a return profit below 15%, that profit is not enough at least to cover up the bank loan you have taken to that investment. So therefore, in this example, the minimum rate of return you expect is 15%. Therefore, and also the bank loan is 15%. No, the investment is totally financed by that bank loan. Right? Therefore, the cost of that capital is 15%. Therefore, the project's cost of capital is the minimum required rate of return on funds committed to the project, which depends on riskiness of its cash flow. Right? Your minimum required rate of return not only totally depends on the bank loan interest rate. There are other risk, operating risk, right? That will decide your cash flows. Second, the firm's cost of capital. Firms. So earlier we have discussed about for a particular investment project. Now we are going to consider whole picture of the organization. An organization have many projects, many investment projects. They have invested in project A, project B, project C, right? There are many different investment in that company. The whole firm is financed by a different sources of finance, right? Say the company is financed by equity, equity shares. Another portion is financed by preference shares. Another portion is financed by bank loan. Another portion is financed by debts, long-term bonds, right? So there are mix of capital. There are many components in that capital structure, right? So each source of finance having its own required rate of return, a minimum, its own cost of capital. Equity capital have different rate, bank loan having a different rate, preference share have different rate, and bonds have a different rate. So it's a mix, right? The firm's cost of capital will be the overall or the average required rate of return on the aggregate of the investment project. It's a mix. We have to combine. So why do we want to study the cost of capital? So that is significance of cost of capital. First, evaluating investment decisions. Before start the investment decision, the financial manager should decide how much profit this investment will be generate, and he should compare this return on investment, this profit, with cost of capital. Say, as I told you, the first example, you have started the investment by the fund taken from the bank loan, that is 15%. This 15% should be compared with their return on investment, right? It may be the project may be produced 30%, 35%, right? Then return on investment is 30% and cost of capital is 15%. You compare, right? If return on investment exceeds cost of capital, you may accept the project. If return on investment is less than 15%, no use. It will reduce the value of the firm. Therefore, to evaluate investment decision, the calculation of cost of capital is important. Designing a firm's debt policy, right? When you consider the balance sheet of an organization, there are many part many parts are included in the capital structure. It combination of It's a combination of debt, equities, preference shares, many things. So a firm will decide how much amount of debts we have to keep from their total equities, total capital. Right? They have to decide. It is based on the cost of capital and appraising the financial performance of top management. For these reasons, we have to study the cost of capital. The concept of opportunity cost of capital. The opportunity cost of capital is not new concept for you. You have studied already in the first year in economics, right? So at this moment, I don't want to explain it more and more, right? It's repetitive to you. Right? The opportunity cost is the rate of return foregone on the next best alternative investment opportunity of comparable risk. So you have two options. option A, option B. So when you choose option 1, you have to lose, you are not able to choose another. It's a mutually exclusive opportunities. Right? If you choose one, you have to lose another one. So this time you have to take decision. What is the best? Then the opportunity cost is what is the next best opportunity you have not taken. When we look at the cost of capital with risk preferences, the most risky or the most opportunity cost of capital is equity shares, then preference shares, then corporate bonds, and government bond and risk-free rate. So based on the risk and opportunity cost of capital, the rate on investment will increase. And shareholders' opportunities and values. The required rate of return, the opportunity cost of capital, the shareholders in market determine. In all equity financed firm, it's mean 100% financed by equity. There's no debt on their capital structure. The equity capital of ordinary shareholders is the only source to finance investment projects. The firm's cost of capital is equal to the opportunity cost of equity capital, which will depends only on the business risk of the firm, right? Uh, Take a firm. This firm is totally financed by equity. It means in that firm's capital structure there is no debt. The firm's cost of capital is equal to equity shares, equity capital, cost of capital, right? It totally depends on business risk. In future, you will study what is business risk, what is operating risk, what is finance risk. And creditors, clients, and opportunities. Creditors means the lenders, right? Loan providers. Creditors have a priority to climb over the firm's assets and cash flows. At the time of liquidation of firms, the loan providers having more preference, more priority to claim their capital. The firm is under a legal obligation to pay interest and repay principal. There is a probability that it may default on its obligation to pay interest and principal. Corporate bonds are riskier than government bonds, since it is very unlikely that the government will default in its obligation to pay interest and principal, right? You have two options. Either you can invest your money into government bond, or you can purchase corporate bonds. Some companies issues bonds to finance. So when we compare these two options, investment on government bonds is comparatively less risk, right? Therefore, the of cost of capital and required rate of return is comparatively low to government bonds than the corporate bonds. Right. The general formula for the opportunity cost of capital. The opportunity cost of capital is given by the following formula. Right. I is the where the I is the capital supplied by the investment. C is the cash flow, right? And 1 plus K, cash flow to 1 plus K. So this is the general formula. Where I, and if it is a bond, it will become B. If it is equity shares, it will consider as E, right? Where I 0 mean the time today, T equals 0. Where I 0 is the capital supplied by investors in the period 0. It represents a net cash flow to the firm. CT, cash flow at time T, are returns expected by investors. They represent cash outflows to the firm. and K is the required rate of return or the cost of capital. The opportunity cost of retained earning is the rate of return which the ordinary shareholders would have earned on these funds if they had been distributed as dividend to them. Right. Cost of capital. Viewed from all investors' point of view, the firm's cost of capital is the rate of return required by them for supplying capital for financing the firm's investment projects by purchasing various securities. The rate of return required by all investors will be an overall rate of return, or sometimes called as a weighted rate of return, sometimes called as WACC, weighted average cost of capital. A weighted average cost of capital versus specific cost of capital. Simply, weighted average cost of capital is the firm's cost of capital. Specific cost of capital is for the particular project. The cost of capital of each source of capital is known as component or specific cost of capital. The overall cost is also called weighted average cost of capital, WACC. The relevant cost in the investment decision is the future cost or the marginal cost. The marginal cost is the new or the incremental cost that the firm incurs if it were to raise capital now or in the near future. The historical cost that was incurred in the past in raising capital is not relevant in financial decision making. Determining component cost of capital. Generally, the component of specific source of capital is equal to the investor's required rate of return, and it can be determined by I equal cash flows, present value of each cash flows. But the investor's required rate of return should be adjusted for taxes in practice for calculating the cost of specific source of capital. Right, now we have come to the most important area of this chapter, right? It's all about calculations, right? And you know that as we discussed, the debt, the bond, there are three types of bond. There are three types of bond. The number one, the bond with maturity. 1 minute. right? There are three types of bonds. The first type of bond, the bond with maturity with coupon rate. Second, the bond without maturity, it is called perpetual bond, and this bond doesn't have maturity period, but it has coupon rate. The third type of bond is pure discounted bond. It has maturity period but no interest coupon rate. Right? So the same three types of bond will be considered here to calculate cost of debt. Keep in your mind the bond, the debt. Sorry, the bond is the uh, is, is the debt instrument. It's a debt capital, right? If I have whiteboard, I can explain you very easily. But anyhow, I try to manage. So debt issued at par. So KD means cost of debt, sometimes called as I. I mean interest, right? I, cost of debt equal interest. Interest means the coupon interest divided by value of the bond today, right? B naught. If debt issued at discount or premium, value of the bond equal, remind this formula, right? We already discussed this formula. Value of the bond today is equal summation of interest divided by 1 plus KD. It means present value of future interest, future cash flow plus maturity value of the bond and its present value. In case of tax, we have to find after tax cash flow. So the after tax cost of debt equal cost of debt minus 1 minus T. From this slice onwards, you have to give more attention. Right, now we move to the example. Right, uh, a 7 year, a 7 year rupees 100 debenture of a firm can be sold for a net price of 97.75. The rate of interest is 15% per year, and bond will be redeemed after 5% premium on maturity. The firm's tax rate is 35%. Compute after tax cost of debenture. Can you tell me what type of bond is? What type of bond? Does it with maturity and coupon rate, or pure discount bond, or a perpetual bond? Please respond. I want to test your understanding. If you don't understand what type of bond, it's useless. Right? No answer, no response. It's normal bond. Only 1%. Yeah, right. This bond is with maturity with coupon rate. Right? Good. Let us work on this. First, we have to understand the formula, and we have to understand what they ask for. Right? we will work out. Right? This is the formula, right? Here, uh, what we have studied in the previous chapter, we find D naught, value of the bond today, D naught. And we have found this interest based on their coupon rate, right? Interest payment. This value also is given maturity value, right? And they have given us cost of debt, cost of debt, right? But in this chapter, we have to find out cost of debt, right? We have to find out cost of debt, but they will give us value of the bond today, right? In the question, they will give you information about value of the bond today, coupon rate, and maturity value. They are asking for cost of debt. They are asking for this cost of D, KD, right? That's a different. Same formula, right? Same formula. So we can substitute B naught here, coupon rate, the interest payment here, maturity value here. So everything here they will give except cost of debt. We have to find out, we have to work out to find out the KD. Other than this, all are remain same, right? See the question. A 7 year, right? 7 year, 100% debenture of a firm can be sold at normal price of 97. So they have given us B naught. Price of the bond today is 97.75, right? And the number of years, 7 year bond, and coupon rate is 15%. Coupon rate is 15%. And the bond will be redeemed at 5% premium on maturity. So the face value of the bond is 100. It will be redeemed at 5% premium, mean is 105. 105 rupees. 105 rupees. And tax rate, corporate tax rate is 35%. And the compute after tax cost of capital, cost of debenture. They're asking for KD. This is the question, right? They're asking for KD, right? So the formula is this. This is the formula. So B naught is given. So interest rate, we can find interest payment. How can find interest payment? Coupon rate is 15%. The face value is 100. Therefore, the coupon rate, the interest is 1000. Sorry, yeah, 100 into 100 is the face value into 15%. 15 rupees, right? Interest payment is 15 rupees. T is for 7 years, right? And BN, the value of maturity value is 105, right? So the information is not provided us is KD. We have to find out the KD. So how can we find the KD? How can we find? right? How can find it, right? So as we did earlier, let me work out on this year cash flow, and this is KD, isn't it? KD year 0, 1, 2, 3, 4, 5, 6, and 7 years. End of the 7 year, we will take in the maturity value also. Therefore, I have put 2 times 7, right? And cash flow, right? To purchase this bond, how much you have to invest today? How much? Please respond. To purchase this bond, how much you have to spend today? How much? How much you have to spend? You have to, you can buy this bond at market price today. So how much the market price? Dylan Madhushanga, please respond. You can respond in chat box. Yes, no, 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 not 100 rupees. Yes, exactly. Who says? MS 104. Yes, 97.75. 97.75 you have to spend to purchase 1 unit of bond. One bond. Is cash inflow or outflow? 97.75 cash inflow or outflow? Cash inflow or yes, outflow. Then we have to put minus or bracket, right? Minus. And end of year 1, how much you will receive on that investment? How much you will receive? Once you purchase this bond, how much you will receive interest end of first year? How much? Isuru Fernando, how much? Face value is 100, coupon rate is 15%. Therefore, you will receive how much? 15 rupees every year. End of every year, you will receive 15 rupees until its maturity. Until its maturity. And end of the maturity, you will receive how much? Maturity value. How much maturity value? Is 105. Right? Uh, then cost of debt is not provided. We have used this figure. We have used this figure. We have used this figure. Here we have used P naught, that is 97.75. Interest payment is 15 rupees, and value, maturity value also we have applied. We have to apply one thing. That's what we have to apply KD. That's we have to find. Yeah, KD. So we have to find KD. How we can find KD? To that, to find cost of debt, this kind of bond, we use a trial and error method. Trial and error method. Trial and error method means IRR method, internal rate of return method. Right? Yeah. By trial and error, if we find 97.75, we will work out. Right? We will work out. We will take 16%. Right? First, we will take 16%, and no, the 16% are the answer. We will take two values, 10% and 20%. We will take 15% and 20%. We'll see. Right. We'll take two values, right? For cost of debt, we will take first 15%. We'll take 15%. Right, is one. Here, how much here? Equal 1 divided by 1 plus, we'll take not 15%, we will take 14, right? Not 12, we'll take 12%. 12, 0.12, the year 1, right? 2, 7 years. Right? We have to find the present value, PV, right? And cash flow into, and this value, right? Present value. These are the case outflow. These are the case inflows. Right now, NPV is, now the NPV is 18%, right? It's a plus value, and we will take another rate, right? We will take another rate called KD equal, say, 14. We will take 18%, right? We take, say, again 1 is 0, 1 over 1 plus 0.18 power. We convert the future cash flows into present value. And present value, well, this is the cash flow into this conflict. Now we will find NPV. 7 point minus 7.615. So we have two rates, right? What's the NPV formula? NPV formula is what? I can take this image is IR, right? So this is the IRR formula, right? We will take, say, A A, B, and small a, small a, small b. Capital A means NPV, NPV higher value. How much NPV higher value rate is 12%, is 12%, and higher value is 18%, right? Small a means capital A is NPV value, that is 18.23, and B this value, right? Now we will work out on IRR, right? IRR equal um, A, capital A. Capital A is how much? Capital A is 12%, right? So we'll apply, right? Grade A. So I can draw the formula. We apply this formula. RA means capital A here. RB means capital B here. Small a means NPV A. Small b means NPV B, right? Right. Now we apply this. RA, that means capital A is 12% plus, and for that we will solve this one, right? We solve NPV, right, A minus B, A minus B equal A 18% minus 25.5, right? And A divided by A minus B, right? That is equal A equal 18 point, and A minus B equal square. Then square. Right, now we will take A is 12% plus this value, how much? 0.7051 into A minus B. A is 12%, sorry, B minus A, 18% minus 12%, right? 16.23. This is the answer. This is IRR. This is KD. Right? Have you understood? Have you understood? Any questions, please? Finance management is all about calculations, right? Mathematics. Any questions? And also there's a tax, right? So tax, after tax cost of capital equal here KD 1 minus T, right? In this example, we have found KD is 16.23%. After tax KD equal KD minus, sorry, KD 1 minus 35%. equal 16.231 1 minus 0.35 10.55 right 10.55 right approximately 10 point right, both are correct answers. Any questions? Any questions? Any questions?